some berries, some of you may ask. Nuts are really high in fat, they're high in protein, so basically carbohydrates.
Okay, so can you hear me?
Yes.
All right, so about the quiz, I curved those two questions. I actually knew it when we were going over it because they were the two that said cash sales. Sales came in that were a certain dollar amount, and they gave us the percentage of the sale that was cash. And then we were supposed to apply like the collection periods to it. And I saw it when I was doing it, and I just couldn't redo it. So if you had read it, some of you got it right, because if you read it, it said, you know, like we made sales of 63,000, of which 80% was on credit. So it was only the 80% that we had to deal with, you know, coming in over the next several periods. Okay. All right. So here's the game plan. How did week 3 go? Your scores were really good. I know the homework was a nightmare, and I actually did 2 things about that. I haven't contacted anybody yet, but I'm going to. But the 2 things that I did was I looked at your quiz score, and let's say you got well, if you got an A on the quiz, I automatically gave you full credit for the homework. But let's say that you got a 80% on the quiz. I went ahead and gave you 80% on the homework also. So I was hoping that that would kind of help it. Some of the problems were really long, I know, because I helped some people with them. All right, any other comments? You're really quiet. Did I scare you away?
I have a quick question, but it's about the paper actually, or
Okay.
the project.
Yeah,
Do you
okay.
have to put it in a paper form and like answer those questions, but like in essay format?
No, you can answer them like 1, 2, 3, 4, 5.
Okay.
In
Thank
fact, when you answer them, make them easy for me to find the answer.
you. Okay.
I want to be able to skim down them and just go, there's that there. Think of it as a treasure hunt. Like there's that, there's that, there's that, there's that. Yeah, what I don't like about it is that it's not written in paper form.
Okay.
And it's not researched, really. And it's not never mind. Okay, so there's 2 things tonight. This chapter on
I have a question.
oh, I have a flip-flop. That's why I'm like, wait, this isn't the right one. It's the other one, chapter 23. Yes?
I came in late, but I heard you talking about the quiz. I just looked. My quiz score went down the opposite way.
It did?
Yeah, I had an 80, and now it says 80.
Okay, anything's possible today. I have been so sick for the last week, it's ridiculous. Well, I want to fix that because it should have gone up 8 points. It should have gone up 8 points. Okay, so who just said that?
Corey.
Okay. Anything's possible because when I was doing it in the grade book, check her. My eyes were tearing up so much that I couldn't see what I was doing. Now I've taken so many decongestants that my mouth is like cotton, but I can breathe right now, so I'll just take that. All right, so this chapter. Wait, I'm still there. There we go. This chapter, so chapter 23 is the one that's so magical because in chapter 23, what we do is we take what we have already learned about contribution margin, and we start using some of the things that, some of the tools that we have, we start using them to apply and, hold on. There. We start using them to apply to different scenarios to make business decisions. And this is when it really comes to life. So that's, there's several different scenarios we're going to walk through in this chapter. The next chapter is about how do you make decisions about like capital investments. And capital investments are like, should we buy a new piece of machinery? Should we buy a new van? You know, things like that is capital budgeting decisions. So I think that there's only 2 chapters this week. This one is like magic, really important. So I think that we're going to have plenty of time to go over both chapters tonight and work some of the practice problems, which leaves us with Thursday only doing quiz review, final exam review. So the other thing is I'm still coughing terribly. I'm taking tons and tons of cough medicine, and it seems to be okay at the very moment. But if I start coughing, I'll just mute myself and take a break and cough my head off and come back. Okay. Anything else? We're good on the paper or the thing. Okay. Nothing else? All right. All right. So what we're going to look at here is we're going to look at the first part is, and this is really interesting, is what costs are relevant when you're trying to make a decision. Because just because there is a cost doesn't mean that it is relevant to the decision that you're trying to make. And I'll give you some really good examples when we look at this, because this is one of those things where even senior management will get caught thinking of a cost as something that's relevant in the decision-making process when it isn't. So the only costs that would be relevant are the ones that apply to your decision, would change, that have a bearing, that if we did this, this is going to happen, and if we didn't do this, this is going to happen. But in addition to the actual cost, because, you know, we're used to thinking about, if I want to buy a new van, well, that's going to cost me, you know, $35,000. Well, there's also costs that are avoidable. So we want to look at, you know, like, what are the costs in the future? What are the future costs? And also, what am I giving up by making this purchase? Because it's just like at home, you know, if I can't buy the camper and move and buy a new car and go on a week-long trip to Disneyland and buy 4 kayaks. I mean, you can only spend the dollars once, so you have to pick and choose. We really did think about this last summer. So we have to pick and choose, and so that's where you're looking at like opportunity costs. You know, what is important to me, which isn't anything different than what you did when you decided to go to school. And we're also going to talk about how all costs aren't readily evident in what you're doing. You know, like when you think about the cost of school, obviously you think about the cost of tuition, right? And you think about the cost of books. But there are a lot of other costs that are associated with going to school. And we're going to look at how that plays into decision making. So we're going to look at 3 different categories of costs. And they're not all relevant, because sunk costs are the only one on here that they are not relevant. But sunk costs are where management gets tripped up more often than any other time. So a sunk cost is something that you've already spent, and so it's gone, right? So it's like, let's say I bought, last year we were going to buy kayaks, and they're expensive. I mean, when you have to buy it in 4s, right? If you have to buy it in 1s, they're cheap. But, you know, by the time you buy them in 4s, and then of course, you know, my husband wants to fish off of it, and yeah, just so then you have all that stuff, and then of course you want a camper to take it with you. But anyway, so we looked at them and we thought, you know what? They have some that are inflatable. Those might be fun. You know, we could put them in the water. We can see how we like kayaking, right? So we went ahead and we bought like 4 inflatable kayaks. I don't even think we used 2 of them. I think that before we ever even got out there, I think I was working, and my husband and my daughter went out. kayaking, and they rented kayaks, and then we ended up buying 2 adult kayaks for my husband and me, and then within the next month 2 more for the kids. So those, I could have said, yes, but we already spent the money on these inflatable kayaks, so we need to use them. But the truth is that they didn't fit in our plan. They didn't work like we thought they would. So they're kind of a sunk cost. It's like that cost is gone. It's spent. And so it really doesn't have any bearing on whether I buy them a plastic kayak, because we already spent the money. Now I have to decide right now, from where I am right now, do I want to buy a plastic kayak? In business, however, it can become really confusing because the cost can be really high. Like, for instance, I worked for a university, and the university got a new system. They were really happy about it. They got a new system to manage all the students. Paid over $1 million for it. And when they got it all in place, they realized that it just simply did not perform the way they thought it was going to. And they were really disappointed in it. So the first thing was, do we throw, one thing that companies often think about is, well, if we spent another, $500,000 or another $1 million, we might be able to get it, I mean, not the way we want it, but, better. Should we go ahead and do that? I mean, we still won't be happy, but the idea is, that comes out a lot in management meetings, is the idea that, well, we've already invested so much money that we need to go ahead and try to get something back from that amount of money that we invested. And that's where management goes wrong. That's a sunk cost. So what they need to be thinking is, okay, that was painful, right? But if I was really looking at all of my options right now, what makes the most financial sense? And quite often it was starting over, which this school ended up doing. While I was teaching this class, I had one of my students in graduate school that was in a management meeting, and they actually started debating exactly this. They had done something that cost, like $2.5 million, and for another $1 million, they might be able to get it to work, but they weren't sure. But they didn't want to just throw away the $2.5 million that they'd already invested. And he was sitting there, and he was lower management, so he didn't say anything. But he was sitting there thinking, wait a minute. I know what that is. That's a sunk cost. We learned about that. We shouldn't take that into consideration. Now, the problem that you come into with not taking a sunk cost into consideration is that you still spent the money. So like with the school that spent, over $1 million on this student management system, we might realize that we needed to redo it entirely, but we no longer had the $1 million. So, sometimes you realize that you need to redo it entirely, but you have to wait. Another thing that you have to look at is out-of-pocket costs. A really good example for out-of-pocket costs for a consideration that I know you're familiar with is, have you bought printers for school? Have you bought a printer to use for school? Yeah, and so when you buy that printer for school, the biggest expense, you see the one and it's like, wow, I can get this printer for $59 and it's color too. This is like totally awesome. Wow, why wouldn't I want to do this? And when you start comparing prices, what really is the cost of a printer? What do you spend your money on? The ink. You spend your money on the ink. Right. So if you had a printer that it was expensive to replace the ink, those future out-of-pocket costs need to be part of the consideration because they can be substantial. They can make the whole difference between it being affordable or not. And then opportunity cost. So opportunity cost is what I was talking about with the cost of going to school. So what is the cost of earning your undergraduate degree? You have the cost of your classes, obviously, and the cost of your books. What else? What are the other costs of your undergraduate degree?
Time.
Time. And it's an opportunity cost because before you were in school, did you spend all of your time reading textbooks?
No.
No. What did you spend your time doing?
Raising toddlers.
Probably still doing, right?
Yeah.
Working, right? You can't, oftentimes when you're going to school, you give up financial gain from working because you can't work as many hours right now and go to school. I mean, the idea is that in the future, you'll recoup that investment, but for right now, and what else? What about quality time with your significant other or your children? Right? I mean, that's a tough one because most of the time you are doing two things at one time. You know, it's like you'll sit down to watch cartoons with them, but you're really studying. You know, it's like, well, I'm here with you, right? Yeah, not entirely. Even when you are with somebody, you're quite often not there all the way. So those are all opportunity costs. If you were looking at a business, let's say that we wanted to manufacture a product, and we were thinking about buying a machine to manufacture the product, right? And the part of the opportunity cost is the square foot that's allocated to that machine. Because if we weren't manufacturing a product, that product right there, we could do something else with that square footage. And so that's an opportunity cost. So when we're looking at relevant costs, we have to look at, you know, what are future out-of-pocket costs and what are my, you know, what are the opportunity costs with this choice that I have to make. And I don't normally, I want this to walk through, not, I don't want this to show the answers. Okay, so looking at this one, if we start with the top 5, let's put them as either sunk cost, out-of-pocket cost, opportunity cost. Okay, so oddly, we haven't discussed incremental cost and relevant benefit. That's really weird. You wouldn't think this would be here. We're going to discuss it in a minute. So what an incremental cost is, incremental means the difference between. So the nice thing, so when we look at incremental costs, and the same thing with benefits, relevant benefits is the difference between this benefit or that benefit. The reason that we like to isolate that is because it gets rid of all of the other parts that you don't have to think about again because they haven't changed. So when you look at it from an incremental cost or a relevant benefit standpoint, you're making the decision based on only looking at what's different if I do B instead of A. You know, and that way, 1, you can make the decision more quickly, and 2, the decision's easier to make because it's clearer. All right, so we have additional costs incurred from a course of action. Is that going to be 1, 2, 3, 4, or 5? Sunk cost, out-of-pocket cost, opportunity cost, incremental cost, or relevant benefit? Additional cost.
Opportunity?
Right. No.
No.
Additional
that.
costs, right. Additional costs incurred from a course of action. So we bought the printer today, but we are also going to have to buy the ink.
Out of pocket.
Out-of-pocket costs. Incremental revenue from a course of action. In other words, how does the revenue change? Revenue for us is a benefit. So we're going to say that incremental revenue is a relevant benefit. A future outlay of cash.
Oh, isn't that out of pocket?
Still out of pocket.
Oh.
A potential benefit that's lost from taking a course of action. Opportunity cost. A potential benefit lost because we did something else is an opportunity cost. A cost that arises from a past decision and cannot be changed. Sunk cost. And of these 5, only one of them is not a relevant cost. In other words, only one of these is something that we shouldn't take into consideration when we're making a decision.
Sunk cost.
Sunk cost. Okay, good start. All right, so now we're going to look at the magic. So we're going to use relevant costs to figure out whether we want to make a decision, you know, what we want to do with our money. So one of the things that we often think about is, should we accept additional business? So let's say that somebody comes to us and we've already met, and we've already met all of our fixed costs. And the reason that's important is because until we've satisfied our fixed cost, our contribution margin isn't just profit, right? We still have to figure out what we have to contribute to meet those fixed costs. So we're just going to look at incremental costs and incremental revenues. In other words, if we did this, if we accepted this business, what would be the difference in cost and what would be the difference in revenue? Or, you know, how much would this particular job cost us and how much would we make from it? So right now we sell 100,000 units of our product. We're operating at 80% of full capacity. The reason that's important is because if we're operating at 100% of capacity, can we take on another job? No, we're going to have to make major changes. We're either going to have to start a new shift, or we're going to have to buy new machinery, or we're going to have to move into a larger space. But so if we're operating at 100% of our capacity, we have to incur additional fixed costs in order to take on the job. So we're only operating at 80% of our capacity, so we have some room. The company has a per unit and annual total sales as shown below. So when we look at this, we see, okay, the sales are $10 per unit. We know our variable costs have direct materials, direct labor, variable overhead, and selling for $240 a unit. We have fixed overhead and admin expenses. And so our total operating income, we get like $1 a unit for profit. And right now we're selling 100,000 units. So right now our bottom line is $100,000. All right, are we good with the data? Can't talk. Yeah. So now, a current buyer of our products wants to purchase additional units of its product and export them to another country. They offer to buy 10,000 units of the product at $8.50 per unit. Now, that's $1.50 less than what we're selling things for right now. So you might say, well, why would we do that? I mean, why wouldn't we find a job for, you know, $10 a unit? Okay, but we don't. We have excess capacity and we're not producing as many units as we could. So we could produce more for them, another 10,000 units, but we're only going to make $8.50 a unit. So we want to know, does that make financial sense? What is the difference in our bottom line going to be? And we'd like to do it without recreating our financial statements, which we can. So we're going to do it by only looking at the things that are different, the incremental things. So here we have our 10,000 units. So we're only looking at the differences, right? We're going to say, all right, if we made these 10,000 units, we're going to sell them for $8.50 a unit, or $85,000. We know what our direct materials, direct labor, variable overhead, and selling expenses are, and those haven't changed. See, up here we had them at $2.40, something did. $3.50, $2.20, $50. Oh, I bet it 50 change, and $1.40. $3.50, $2.20, $50. Oh, the selling expenses are down. Why are the selling expenses lower? Do we have to do anything? No, they came to us. We just have to produce the units. So there's not as much hand holding, there's not as much sales calling. You know, we figure putting together the deal will cost us about $2,000 with invoicing and all that. But for the most part, so that's less. Now, for our fixed costs, we're not including any fixed overhead. The reason we're not including any fixed overhead is because we've already paid all of our fixed overhead out of our other sales. So if we accepted this job, our fixed overhead neither increases nor decreases. So it really isn't part of the decision. Does that piece make sense? Okay. So let's talk about what an example of fixed overhead would be. So an example of fixed overhead would be the depreciation on the machines, or the janitorial services in the warehouse, or even the production manager's salary are all going to be fixed overhead expenses, right? Well, whether I produce these extra 10,000 units or not, the depreciation doesn't change, the salary doesn't change for the supervisor, because we're not sending him home and paying him 20% less because we're operating at 80% capacity. The rent on the building doesn't change. So none of those fixed overhead costs really change. And we've already met them because we have a profit before. So it's not like we're still struggling to pay them. We've more than broken even. So that's why when we look at incremental analysis, we don't have to include the fixed overhead cost. Now, it turns out that there is a little bit of admin expenses, probably for billing the customer, for shipping the stuff. There's a little bit of admin, not as much as normally our admin expenses are 80 cents. And here we're saying admin expenses are about 10 cents. So if we made this special order, we're making $2 per unit in profit, just looking at the differences in costs and revenue. If we look at it from the 10,000 unit perspective, we're getting an additional $20,000 in profit by doing this job. So the question is, should we do the job? And I'm going to say that the answer is probably yes, because there's 80% capacity that we're at, which means that we could easily slip it in and it wouldn't cause any issues with employee morale or overtime or anything like that. Also, if you look over here, look how much we're making per unit on our regular. We're making $1 per unit profit on our regular production. But here, we're actually making $2 per unit. Even though we're charging $1.50 less, we're making more profit. So we should do it, right? All right, are we good here?
Yes.
Okay, so another one is applying the overhead rate. Now we're going to figure out, do we want to make this part or do we want to buy this part? So let's say that we manufacture refrigerators. Okay, let's say that we manufacture cars, but we buy the carburetor from another company. We could manufacture the carburetor and put it in the car. But right now we're just buying them from another company, carburetors.com, that makes tons of carburetors. That's all they do is make carburetors. There are pros and cons to that. What are the advantages of buying from a company that does that's what they do? That's all they do all day is make those.
Less direct labor cost.
What?
Less labor cost.
Okay, it costs us less in labor, right? What about sometimes they're more efficient, sometimes their price is less than what we could what we would incur to make it, because if they make it in large volumes, then they get discounts on what they order, and so it's possible, that they have like purchasing power and stuff like that that we don't have. What are some disadvantages of buying a part from another company?
The quality might not be good.
The quality control. That's why a lot of companies, like if you have an integral part to your product that you buy from another company, your relationship with that company really becomes more like a partnership. And that's why if you're like, if you're certified in quality control, you often make them be certified too. But that's exactly one of the problems, quality control. What's another one? There's another big issue. What about supply? I had I had a huge issue with that, with something that we were buying. We lived in Colorado, Phoenix, and we were buying it from Florida. And that's where it all came in from. Almost all the companies were in Florida. Some were, but most of them were. And we had everything trucked in from Florida. And that year, 3 hurricanes hit in a row. Bam, bam, bam. It was awful. It's just for Florida, not for me, because I was in Phoenix. But I mean, it became, I mean, ridiculous. And it took out a huge chunk of the freeway that runs, I-10, that runs across the United States. And so trucking things became very difficult. So here I have this supplier that supplies me all of this product, and now it's on back order and it can't get to me. And I'm having to call my customers and explain to them that I can't finish the job because I can't get the product because they can't get it to me. I actually had some customers say, why not? What's going on? It's like, really? The state's underwater. Do you watch the news? Have you looked at a newspaper? Hurricanes. Well, I just don't see what that has to do with my part. Well, the freeway kind of collapsed. And so the big truck, it's like, well, I don't know why it should affect me. It's like, okay, why don't you go home and live in your little microcosm? Because you're clearly not going to, this conversation is not going to work. Okay, so what we're thinking about now is, do we want to make the part or do we want to buy the part? And there are considerations besides dollars. So when you look at all of these and you use these techniques to make decisions, there are things that you have to think besides dollars and cents. We're looking at the dollars and cents. We'll talk about the other things you have to think about. So make or buy. So if we make the part, the materials cost us 45 cents, the labor costs us 50 cents, we're going to allocate factory overhead of 50 cents. So it would cost us, we estimate, $1.45 to make the part. So then you would say, okay, if it costs less than that to buy it, we'd be done. So we're going to look at, let's say that a supplier is willing to sell it to us for $1.20. Now, we can't just go off of this amount, because how did factory overhead get there? Is factory overhead an actual number or an estimated number?
Predetermined.
Right, it's predetermined, and it's an estimate. So do we necessarily have to apply 50 cents of factory overhead to the part? Maybe not. You know, maybe not. All right, so if we're going to look at the two differences, we're going to say if we make the part, well, we know we have the 45 cents in materials, and we know we have the labor. We're not sure about the overhead. But if we buy the part, we know it's going to cost us $1.20. So we have to be able, in order to get our part down, we have to get rid of 25 cents of the overhead in order to get our part down to less than $1.20. So then the question is, can we do that? Does that make sense to reduce the overhead? You know, is there a good reason for that? So if so, right, then we can make the part for less than buying it. So it might make sense to make it. Now, this is one part of the analysis for a make or buy, because there's another piece to it. If we decide to make this part, what happens in our production facility? If we decided we're going to make the carburetors for the car, what do we have to do?
Pay rent.
We have to do what?
We have to pay rent for the factory.
We might, right? We might have to expand, but even if we don't have to expand, we're going to allocate square footage to it, right? We're going to allocate square footage. We're going to allocate labor. So that's where opportunity cost comes in. Because even though you're not going to take that into account in this problem because they didn't give it to you, in the real world, you would think about this here too. You know, because now one of your questions also is, okay, so if I make the part for about what I can pay for it, do I want to make the part? Well, if we're having quality control issues or we're having supply issues, then maybe we want to make the part. Or maybe there's something else that we could make that we could sell for a profit using that same square footage and the same employees. And so that's where looking at opportunity cost becomes important.
But question.
Hmm?
So if we make the part, don't we get depreciation cost for our equipment?
Yes,
That will be overhead, right?
that would be overhead. If
So
we have to buy new equipment for it, that would be overhead.
So overhead should be included, right?
It should be, depending on what we have to buy to make the part.
Okay.
It could very well be. And yes, then it would be. I mean, and plus, what we're going to look at in the next chapter is like, if let's say we had to buy a piece of equipment to produce those. Does it make sense to buy the piece of equipment to produce them? We're going to look at that too. Okay, another question is, should we, let's say that there's a problem, like we made those cushions and they didn't fit the sofa. Should we throw them out and just start over, or should we fix them? Because reworking can sometimes cost you more money than just simply starting over. I mean, have you ever tried to like redo something? It's like my seamstress that does my daughter's skating costumes. She would much rather, I mean, she builds stuff in so that if she grows, she can take it out the next year and all. But I mean, what she hates is when you bring her something that somebody else has done and ask her to fix it or modify it, right? She would much rather start from scratch. It's a lot harder to take something apart and fix it. So one of the questions is, do we want to scrap it or do we want to rework it? But the other important thing about this is recognizing that this costs money. There's a real cost of quality control. I mean, there's a cost that you can assign dollars and cents to. It really costs money. So scrap or rework. So says as long as the rework costs are recovered in the sale of the product, then we should rework it rather than scrap it. Because you want to look at which is going to hurt me the least. Neither one is a good situation. Which is going to hurt me the least? You know, it's kind of like with the cushion. Sometimes I could reuse the fabric. Sometimes I couldn't. Sometimes it wasn't worth the seamstress's time to, you know, rip all the seams. And then you have the ones that you manufacture them and you look at them yourself and you say, this is not high enough quality. You know, what do you do about that? That's a sunk cost. You can't do anything about it. You just need to move on and learn, of course, to try to not have it happen in the future. All right, so let's say that Fast Track had 10,000 defective units and we paid $1 to make each one of them. We could scrap them for 40 cents each. Or if we reworked them, reworking them would cost us 80 cents per unit. So now we have $1.80 in them. If reworked, the units could sell for the normal price of $1.50. Okay, so at least but we spent $1.80 on them and now we're selling them for $1.50. So we're selling them for a 30-cent loss. Reworking the defective units will prevent the production of 10,000 new units that would also sell for $1.50. Because while we're spending the time reworking them, we're using our machinery and our labor and they're not producing new. And so I bet you can tell just by looking at the numbers here, which we would want to do. Because if we fix those 10,000, we're actually losing 30 cents per unit. And if we just say, as painful as it is, throw them out, start over. We'll just pretend like for the last week we didn't do any work. So we're going to look at the differential cost. So if we scrapped or sold them, to scrap them we get 40 cents. If we rework them, we get $1.50. If we rework them, it's going to cost us 80 cents. And then also the opportunity cost of not producing new units. So we have to include that in there because if we were not reworking them, we could produce new units. So now you see, if we rework them, we get 20 cents per unit. If we scrap them, we get 40 cents per unit, which again is painful, given we should get $1.50 per unit, but what are you gonna do?
Where did the 50 cents come from?
When we looked at the, we said that reworking the defective units will prevent the production of 10,000 new units. It would also sell for $1.50. So 10,000 divided by $1.50. 10,000 divided by $1.50. Well, that's not it. Oh, we'll sell for $1.50.
Oh, the difference between the cost and the selling price, right?
The cost and the selling price. Because we're always looking at the difference. Yeah, so we would get 50 cents per unit in profit if we did the 10,000 units from scratch. So now you can see we might as well just throw them in the dumpster and start over. Painful, but sunk costs are usually painful. Okay, another question is, do we want to sell what we have right now or process further? So an example of that is milk. You know, it comes out of the cow. We make dairy products with it. The more we refine it, the more it costs. Another example is gasoline, oil. You know, it comes out of the ground and we refine it into different, you know, pieces. Have you ever shopped or heard about those furniture stores that sell unfinished furniture? You know, where you can then go and finish it yourself. So the question is, when do we stop and sell? When is the most profit? Is the most profit if I stop now and sell, or if I put additional money and resources and time into it where I can sell it for more, but I've also spent more? So let's say that Fast Track has 40,000 units of a partially finished product queue. So far, we've spent $30,000. The 40,000 unfinished units we can sell for $50,000 right now. So we spent 30 and we can sell them for 50, so there's 20,000. Or they can be processed further into products X, Y, and Z. If we process it further, it's going to cost us $80,000, but we'll get $150,000 in revenue. So if we put that together and just look at the differences, if we sell it as product Q, we sell it for $50,000. If we process it further, we can sell it for $150,000, but it will cost us $80,000 to process it further. But if we did that, instead of getting $50,000, we'd end up with $70,000 in profit. So what are we going to do?
Process it further.
Yeah, we're going to process it further. Now, when we talk about like other factors in the decision, some other factors in the decision might be like maybe we have customers that want Q, X, Y, and Z. And if we just produce X, Y, and Z and not Q, then they'll go somewhere else. And when they go somewhere else to buy Q, they'll probably find X, Y, and Z. So we might produce some of Q, some of X, Y, and Z just to keep our customers happy. But maximizing profit, if it wasn't for customers, would be just producing X, Y, and Z. And that's what I'm talking about with sales mix. So when you're looking at sales mix, one of the issues that we have is that there's always constraints. There's always constraints. There may be labor constraints. There may be machinery constraints. You can only run it so far through this point. We've got bottlenecks there. There may be time constraints. There may be materials constraints. You can only get so much of something. But there's absolutely always constraints. And so what you can use actually is the contribution margin to figure out what you want to produce the most of, because the contribution margin. Oh, Peter, you raised your hand. What would you like to say?
I was just playing with it.
You were just what? Playing with it? I like that. I didn't know you could do that. Thank you. So that's good. We need to play with more things. Unfortunately, I'm sick and I can't remember what I'm saying. So the contribution margin tells you how much profit goes into your pocket. So ideally, in the sales mix, ideally you'd want to make whatever produces the largest amount of profit, right? Or whatever has the largest contribution margin. But because of constrained resources and because of customer demand, we're probably going to create a mix for our sales. So let's say that we have two products, A and B, and A and B both use the same machines. And A sells for $5 and B sells for $7.50. The variable cost for A is $3.50 and the variable cost for B is $5.50. So the contribution margin for B is $2 and the contribution margin for A is $1.50. So even though B costs more to make as far as variable costs, we make more profit on it. All right, so now let's throw in there, it takes 1 hour to produce 1 unit of product A. It takes 2 hours to produce 1 unit of product B. So now we get into, we have a machine hour constraint. The machine can only run for so many hours a day. And if I make product B, I can only make half as many as I make of product A. So now we have to say, okay, if we take that into consideration, now which one earns me more profit given that I can produce twice as many of product A than I can of product B? So I'm looking at the selling price for both of them at $5 and $7.50, the variable costs, so there's my contribution margin, but the product A takes 1 machine hour, so my contribution margin per machine hour is $1.50. Product B takes 2 machine hours, so my contribution per machine hour is only $1. So now, which product makes me more money?
A.
A. Now A makes me more money. Now, that doesn't mean, so if I wanted to just maximize profit, what I would do is make only product A. What are some of the reasons that even though product B is less profitable, I would still want to produce product B?
Demand.
We'll make profit.
I do make a profit, but what else? What about my customers?
Demand.
Right, demand. So if my customers want some of product A and some of product B, I probably need to produce some of product A and some of product B. But given the choice, I want to maximize my production of product A because it makes me more money. So that's dealing with a constrained resource. Okay, this is the example that I gave you about my friend who had the commercial real estate business that also did like maintenance, commercial maintenance. And he found out when he looked back on this exercise that he had done, he remembered it from college, and he went down and he thought about it, and he realized that the maintenance part was the bread and butter of his business. And if he hadn't done this, and I mean, he's my age, so he hadn't gone to school in a long time. If he hadn't remembered that and gone and done it, his business literally would probably have gone under during the horrible recession. So when we look at segments, ideally, obviously, you'd like every segment to be making money, right? And so the first thing is, well, maybe we should get rid of the segments that aren't making money. So that's what's happening here. Fast Track is thinking about maybe we should eliminate the treadmill division because it has a $500 loss last year. So if we're not making money selling treadmills, maybe we just shouldn't sell treadmills. I mean, it doesn't make any sense to sell something we're not making money on. I mean, you can agree with that, right? Why would we sell something we're not making money on? That makes no sense. So here's what we have. If we decided to eliminate the segment, we have to look at what's an avoidable expense and what's an unavoidable expense. So in our treadmill division, here's all of our expenses. If we eliminated it, first of all, we're not going to have sales. And cost of goods sold will go away because we're not going to make them. So that's an avoidable expense. The wages expense is avoidable. The depreciation on the equipment is not, because we own the equipment. The equipment isn't going to go away. The rent and utilities expense is not going to go away because we still have the space. Advertising expense can go away. That's avoidable. Insurance expense, part of it's going to go away, but we still have insurance on the rest of the facility, so we still have that cost. The share of the office department expenses. So of the 3,060, see, so what's happened is, right now, if we look at the income statement, we see our $500 loss. We have 3,060 of office department expenses that are in there. But if we eliminated the division, we can really only eliminate $2,200 of that expense. 860 of that expense is going to stay there and just be shifted to a different division. It's not going to go away. The same thing happens with the purchasing department expense because these expenses are allocated. So the purchasing department is allocating by some ratio, $3,190. But when you really look at it, you realize, well, maybe we could get rid of a person because we have one person that does, the purchasing. So we could get rid of $1,000, but the 2,190 is just, it's allocated to the division, but it's not all the division's expense. So, like we allocate it based on square foot, for instance. Well, just because the division goes away doesn't mean the cost goes away. It just means that we're going to allocate it over a fewer number of square feet. So the other divisions are going to get that expense because it doesn't go away. And same thing, so when we're done, so now we say, okay, we have a $500 operating loss, which was what made us think maybe we should get rid of the business. If we look at the avoidable expenses, we could lop off $41,800 in expenses. But the unavoidable expenses, we'd still keep $6,500. So if we eliminated the treadmill division, we're still going to have $6,500 worth of expenses that are not going to be eliminated. Everything else here will be eliminated. The sales will be eliminated. All the avoidable expenses will be eliminated, but we're still going to keep $6,500 of unavoidable expenses. Those expenses are just going to get allocated to a different division. So now we say, okay, so our sales are $47,800. Our avoidable expenses were $41,800. So that means that we're actually, if we eliminated that division, we're not actually losing $500 anymore. Now we're losing $6,000. Because when you look at this, originally we thought, well, we're losing $500. But since 6,500 of those expenses stay, we're actually losing more than 500 if we eliminate the segment. Because when we get rid of the revenue, now we have the revenue's gone and these unavoidable expenses remain. So now we're looking at it and we're saying, oh my gosh, okay, so it looks like we're losing $500, but a lot of it's with expenses that can't go away. If we eliminate it, we're actually going to lose $6,000 instead of $500. So maybe we shouldn't eliminate the treadmill segment. Now, there's other things to think about with segments too. Like if you own a restaurant and the restaurant has a bar, are you going to eliminate the bar if it looks like it's not making money? No, because the customers, because you're going to lose customers. The customers that they come in for dinner want to sit at the bar and have a drink, or want to have a drink at the table. So you can't eliminate the bar. So there's other things to think about too. Like with our company, we sold replacement parts for patio furniture. Didn't make money on it. And it was kind of a pain because there was this huge room of parts, and we had really obsolete and hard to find parts too. But our competitor's truck were often parked in our parking lot, which never ceased to amaze me, because if I was going to go get parts from one of my competitors, I would not send my delivery driver in my big truck with my name on it. But you know, I can't account for that. Made me happy, but you know, we did it as a service to our customers. It also brought customers in, but we did it as a service to our customers. All right, so the last decision we have here is, I think, is do we want to keep or replace equipment? So when is it time to replace that piece of machinery? When is it time to replace the delivery van? So we're looking at, all right, if we bought a new machine, it's going to cost us $100,000. Now, we get $25,000 for trading in our old machine. We're going to save money in manufacturing because it's going to be more efficient. So we're going to save $72,000. So given these, if we bought the new piece of machinery right now, it turns out it's actually going to cost us still $3,000. Now, does that mean we shouldn't do it? Not necessarily, because I mean, this is over 1 year. What if we looked at it, you know, over its lifetime? But oh, maybe we are. Never mind, we are. We're looking at it over 4 years. It's going to save us $72,000 in manufacturing costs over 4 years down here. So, so over its life, we're going to end up still paying $3,000 more if we replace our piece of equipment. So even though we're looking at it and we're like, wow, I could operate more efficiently if I had that new piece of equipment, we can't operate more efficiently enough to make up for the cost of the piece of equipment. All right, pricing. Pricing's really interesting. I did huge pricing models. They're really interesting. So there's some different ways that companies figure price. One of them is called target costing, which is where they figure out how much profit do we want to make? How much does it cost us to make the product? And so based on the target cost and the expected selling price and the desired profit, we know how to price it. Now, the problem is that with pricing, there are other variables besides just cost, because customers will pay for quality if you educate them, right? So apples and apples aren't the same. It's kind of like when I went on a hunt for a cheese slicer that wouldn't break. They don't exist, by the way. I mean, Walmart obviously wasn't working, and Target was a step up, and then I went to, you know, like Bed Bath & Beyond, and finally I went to a really expensive kitchen store at a really expensive mall. They still break. I did the same thing with vacuum cleaners. I have not gotten to the point where I bought one of the $1,000 vacuum cleaners. They'll probably last, but the problem is if they didn't, I'd want to just, you know, like throw it out the window, and then I'd have that expense. So. But there's more, and people will pay for perceived quality too. You know, it's like the cheapest price isn't always what somebody wants. Sometimes somebody wants something that will work more than a week or 1 day. Another way of doing it is you can say, a lot of companies will say, well, whatever we do, like we had a patio furniture store, and his deal was, if I'm not doubling my money, I'm not selling it. I have to be able to double my money. If I'm not doubling my money, I'm not dealing with it. He started bringing in containers from China. There's some issues with that. But so another thing is like, well, what is my target profit? Can I sell this for enough money to make, you know, my 20% profit? And then sometimes you look at variable costs. So this is cost plus pricing. Government contracts are often based on cost plus. So, you know, this is how much it costs to do this, and this is how much I'm going to add on top of that. That's the selling price. Now, the problem with that is if you have underestimated the cost of manufacturing it, especially in government contracts. Okay, how do you feel about this chapter? Next one doesn't have nearly as much. Yes, no, you're quiet.
Good.
I have no voice, so it's not a good time to be quiet. So let's see. 24. Okay, let's take a 10-minute break. Let's come back and let's do the next chapter. See, isn't this easier? It's easier this week, right?
Yes.
Stop recording. Pause recording. All right, I'll be back in 10 minutes. Gonna go kiss children. Stand up and move around so I don't put you to sleep, please. I hate it when I put you to sleep. It's really demotivating for me. I'll see you in 10 minutes. Capital budgeting. So capital budgeting is how do we make decisions about the big things that we want to spend money on, whether it's a project or a large purchase. You do these things at home. I mean, when you look at, do I need to replace a new refrigerator? Do I want to buy a new stove and dishwasher? Those are capital purchases. So the process is normally that you do a capital budget when you do your budget. We just didn't look at that. And we did kind of in the cash flow where we said we plan to spend so much money in, like December buying a new piece of equipment. So the manager would submit a proposal and then it gets reviewed. And then if there's a board of directors, the board of directors would approve it or not approve it. So when we're looking at capital budgeting, it's particularly risky because we're looking at a large purchase that is intended to last for a long period of time. So not only does it require a lot of financial commitment, but because of the time period, there's some uncertainty involved. One of the things that we're going to look at is what's the outflow? In other words, how much does it cost to purchase the piece of equipment? And what kind of inflow is it going to generate? Like if I buy this piece of, if I buy this delivery van, what do I expect to get in, to come in from delivering fees? And then the last thing is, at the end of its life, when I, trade it in or sell it, what is it worth? What can I get back from my initial investment? So one of the easiest methods to use is the payback. And the payback method is super easy, but it doesn't take into account time value of money. That doesn't mean it isn't useful. It's a really good place to start because if you're looking at a couple of different investments and one of them you recoup your money in 3 years and the other one you recoup your money in 7 years, probably you want to go with the one where you recoup your money quicker. So payback method is super easy. All we do is take the cost of the investment divided by, what we think is going to come in each year and figure out how long does it take to recover our payment. Now, let's say that instead of having, a lump sum every year that's the same, so we can't use this formula and just divide it, we might have to do a schedule where we, kind of like figure it out over a period of time. So like here we're saying we want to buy a new machine, costs $16,000. We figure it has an 8-year useful life. And at the end, it's just not going to have any salvage value. We're not going to get anything back at the end. We think that it will produce 30,000 units for us, and we can sell the units for $30. So the cost of the investment is obviously the $16,000. The annual net cash flows is going to be, we expect to produce 30,000 units times $30 each. No, that's not right. Oh, that's 30,000 units for its life. 30,000 units times $30 each divided by 8 years. So each year we think that this piece of equipment, yes, check that math because I didn't do it. Each year we think that this piece of equipment will bring us in an additional $4,100. So the question is, if I spend $16,000 now, and over the next few years I get in money, how long will it take me to make up that $16,000? And the down and dirty, just with quick, payback, is that it takes about 3.9 years. Now, a company would usually have some kind of guideline, like it has to be under 4 years or it has to be under 5 years, or I don't want to consider it. So this analysis is a good place to start, especially if you're considering different projects. But it doesn't take into account things like time value of money. For instance, we spend $16,000 today. Well, if we get $4,100 back this year versus $4,100 back 8 years from now, those two aren't worth the same amount of money, because $4,100 today is worth more than $4,100 8 years from now, because we could invest it. So that's the downside of the payback method. So if it had uneven cash flows, it really isn't any different. It's just that you can't use a formula that easily. So here we're just going to say, okay, we spent $16,000, and in year 3, we figure it'll give us $3,000. So now we're down to 13. In year 2, it'll give us 4,000. Now we're down to 9,500, and we keep going down until we break even and we've repaid ourselves. So if we looked at it this way, now we're saying, oh, it would take about 4.2 years based on, the cash flows this way. So if you have an even dollar amount every year, you can just use that one quick and dirty formula. If you don't, then you have to start, individually subtracting the years off of the purchase price until you get down to 0. All right, so that's,
So when I was doing the practice problems for this on the cumulative net cash flows, why are we doing like the 13,000, 9,000, 5,000? Why is that a negative?
Oh, because they're saying because the 16,000. So we've spent 16,000. We're getting in 3,000. So now we've actually spent 13. We're getting in 4,000. So now our outlay has been 9,000. That's why that's negative.
Okay, because when that makes sense now. Because when I was doing it, I was like, I have the right number, but it's the wrong.
But it's not wrong. It's like, and it's right. And it's like, this isn't a complicated problem. I know I'm putting it together right.
Right, because when I was doing the, so okay, 16,000 minus 13, minus 3,000, it was giving me 13,000, but I was putting positive 13,000.
Oh, gotcha. Yeah.
So
yeah, that's why.
Why it went from negative to positive at the bottom.
Right, because you're thinking I spent 16. Okay, now I have 13. Now I have 9. Right, to make up. Yeah. Yeah. And the truth is, in the real world, it wouldn't matter how you put that together, as long as, you might put that down as a positive number, and then you're subtracting. It doesn't really make any difference as long as you get to the, where you hit 0. But in the homework, because it's computerized, yes, it makes a big difference. That's true. All right, so these are the strengths and the weaknesses. It's easy to use, but it doesn't take into account timing. It also doesn't take into account any additional expenses after the time. Like, let's say, you bought this printer. It doesn't take into account the ongoing costs or the ongoing maintenance. It also doesn't take into account the cash flows that might continue to come in after its useful life. Because remember, one of the things we talked about with depreciation is that we might estimate that this piece of equipment will have an 8-year life, but that doesn't mean that at the end of 8 years we're going to throw it away. It's still probably going to be producing product for us, just like cars do, or the desk that has a 7-year life. You're not going to, oh shoot, I have to go buy a new desk today. It's been 7 years. This one just became useless. All right, so the next one is a little bit more complicated, and it's called the accounting rate of return. And for the accounting rate of return, now we're looking at after-tax dollars and the amount of our average annual investment. So the way we're going to do this is we're going to take, there's 2 ways. The first one is we're going to take the beginning book value plus the ending book value divided by 2. which is our average annual investment. In ratios are always beginning plus ending divided by 2 when we do averages in accounting. Always beginning plus ending divided by 2. The other way we could do it is we could say, here's all the individual years average book values and divide it by the number of years of the investment. But I don't know anybody that does it that way. Everybody does it just average is beginning plus ending divided by 2 because that's kind of the rule in accounting. So now we're going to say, all right, let's look at the rate of return. So we've got the same $16,000 investment, and it has an after-tax net income of $2,100. So basically, we know what our net income is, we know what our tax rate is, so we're going to subtract that from the revenue that it's bringing in. So we've lowered the cash inflows based on our tax. So to do the average, we'll take our beginning book value plus our ending book value divided by 2 so now we have, okay, it equals 8,000. So we're saying that each year we're going to return $2,100 after taxes, and the average value of the asset is $8,000, which means that we have an accounting rate of return of 26.25. So now the question is that good? Should we do it based on 26.25, or is that too low? And the answer to that is, it depends on what you're comparing it against, and it depends on what the benchmark is for the company. You know, if the company is looking for a 25% return, then this is great. If they're looking for a 30% return, this is not so great. If they're looking for a 25% of return and we're comparing 2 or 3 different, potential investments, and this one's 26.25, but another one is 28, then, maybe we want to look at the one that's 28. So, but that's how you calculate the accounting rate of return. And so we're looking for the higher the rate of return, the better the investment. Are we good here?
Where do we get the 2 from the annual average investment?
Because beginning plus ending, there's 2 numbers.
Okay.
That's all. Just like if you did an average of your grades for the class and you had 7 grades, you divide it by 7.
And the ending book value is given?
Yes, because there was no salvage. If there was a salvage value, the ending book value would be equal to the salvage value.
Okay, got it.
That's a good question. So this method is harder than the payback method, but easier than a method that takes into account time value of money. But because it ignores time value of money, it's not as accurate or as detailed. This focuses on income, like net income that we're going to get in, instead of like just cash flows, because we're deducting our tax expense from the revenue. Also, this is harder to do on a year-by-year basis. Thank you. This is harder to do. I'm fine. These are fine. This is harder to do on a year-by-year basis because you have to calculate the accounting rate of return each year that the dollar amount that's coming in changes. Okay, now we can also do net present value. Net present value is the first one that takes into account time value of money. And we touched on this a tiny bit when we talked about bonds and financial accounting. And you do it a lot when you work with bonds in intermediate accounting. But what we do for net present value is the idea is that we can't compare today's dollars with the dollars that are coming in next year and the year after that and the year after that and the year after that. Because today's dollars are worth more than the dollars coming in next year or the year after that or the year after that. So also that means that if we're looking at 2 different investments and one of them has more money coming in earlier in its life and less money coming in later versus a company that has more money coming in later and less earlier, the one that has money coming in earlier is going to be more attractive because that money is worth more. Thanks, buddy. Okay, so what we're going to do to calculate the net present value is we have to figure out the present value of the future cash flows. And it's not as hard as it sounds. We have to find out the present value of the future cash flows, and then we're going to subtract whatever we're paying for our purchase price, because that's already in today's dollars. So let's say, so you know these present, and they have them here. So these present value tables that look like this. Have you seen these? Have you used these before in a class? Yes, no, maybe. Okay, so the way this works is,
Yes.
if you look up here at the top, where's my pen? If you look up here, it's not working my pen out right now. If you look up here at the top of the table, see where it says present value of 1? Where's my pen? So up here it says present value of 1. So this table tells you, you could use this table for if I have a future amount. Let's say I'm going to get $40,000 in 20 years. This table will tell you how much it's worth today. Now you have to have an interest rate, so let's say it's going to be at 3% interest. So if I get $40,000 20 years from now, I'm looking at period 20, and I'm looking at 3%. So I simply go down here, and this is the number. So if I multiplied 40,000 times 0.5537, that gives me 22,148. What that means is, if I invested $22,148 today, and I was earning 3% interest, in 20 years, I would have $40,000. That's what that tells me with present value.
I'm sorry, can you repeat that? The 22,148?
Yeah, so if I'm given $40,000 20 years from now, and let's say the market rate of interest right now is 3%. If I was given $40,000 20 years from now, that's the same as being given $22,148 today. Because
No, I understand that. I just don't know how you got 22,148.
Because if I took $40,000 and I multiplied it by the rate that I highlighted, so I'm looking at this and I'm saying, okay, I'm going 3% interest over 20 periods. So I just simply go down to that number. So then I multiply the 40,000 times this rate. So 40,000 times 0.5537 equals 22,148.
Thank you.
Okay. So that's present value of 1, a lump sum. Now, here's the next one. This is the future value of 1. So let's say that I wanted to know if I invest, I'm going to invest, I got an inheritance. I'm going to invest $50,000 at 3% interest. for 18 years because I'm going to use it. I got this inheritance and I want to use it to pay for my daughter's college. So when she's born, I get this inheritance, I put it in the bank at 3% interest, and I want to know how much money am I going to have for college. So I'm going to say, okay, here's 3% interest, and I need 18 years. So when I go together here, that's my number. So let's see what I end up with. So I'm going to take my $50,000 times 1.7024, which equals 50,000 times 1.7024 equals 85,000. What was that?
120.
Thank you. 85,120. So that tells me that we need a scholarship. Because that won't pay for the first year. Okay, so if I invested $50,000 today at 3% interest, in 18 years, I'd have $85,120. Now, yes, it does get more complicated because we can start talking about what if it compounds monthly, compounds weekly, compounds daily, but let's start with the basics of what present value and future value is. Okay, now this one is the present value of an annuity. And an annuity is payments over time. And I want to know the present value. So let's say that I got a $10,000 payment each year for 10 years. And the market rate is 2% interest. All right, so I'm going to say 2% interest, 10 years. So if I take my, now the idea is I'm getting $10,000 every year. So first of all, this is $10,000 plus $10,000 plus $10,000. It's $100,000, right? Because it's every 10 years. So I'm going to take 10,000 times 8.9826, which equals, okay, I'm going to feel really stupid here, 8.9826, which is obviously
89,826.
So I said as I was doing it, I'm like, that's obviously stupid. So what this means is, if I was going to receive $10,000 every year for 10 years, and it was in the bank earning 2% interest, it's the same as receiving $89,826 today. So if somebody said, do you want me to give you $89,826 today or $10,000 every year for 10 years, and the market rate of interest was 2%, those are the same. Now, last but not least, here's the future value of an annuity. So the future value of an annuity is like if I invest $50,000 a year for college at 4% interest, what will I have in 18 years? My kid's born and I decide I'm going to invest $50,000 a year, every year and I'm going to put it in a CD with 4% interest, which doesn't exist nowadays. So 4% interest at 18 years. So here's my number. So if I take my $50,000 annual investment times 25.6454, I end up with how much did I invest? 50,000.
1,182,270.
1,182,000.
282. 270.
Now we don't need a scholarship.
270.
My child can go to college and I can retire. Wish I'd done that. I could still do that if McKenna stopped skating. Okay. That's depressing. All right, so the best way to understand these I found is with examples. All right, so that's how this works. So now let's go back here where we can make sense of it. Okay, so for net present value, we have to bring everything back. For net present value, we have to bring everything back to today's dollars because next year's dollars aren't the same as today's dollars. So what we're doing here is that this project has, I'll show you a faster way of doing this. This project has 8 payments of $4,100. So let me show you something. So this is actually an annuity because they're a series of the same payment, right? So if I really wanted to know what the present value is, what we've done here is we went to the table. So the present value of 1 at 12%. So what we did here, which is how annuities work, we went here and we said at 12%, we've got 0.8929, 0.7972, 0.7118, which if you look back here, is what we've done, 0.8929, 0.7972, 0.7118, but there's an easier way of doing it. We could say we have an annuity of $4,100 for 8 periods at 12% interest. So now if I said, okay, let's take 4,100. Let's go to our annuity table for number of years 8, interest 12. We want to know the present value of the annuity. So present value of an annuity for n equals 8 years, right? Yeah. And I equals 12. So here's 12. So we're going to go 1, 2, 3, 4, 5, 6, 7. So 49676. So if we go back here, times 4.9676. $20,367. Right, just using the annuity table.
The present value of annuity, right?
Yep. So now, so what we're saying here is we're saying, okay, if I get $4,100 cash flow each of the next 8 years, what that's really worth in today's dollars is $20,367. Now, if I added up all of the 4100s, I end up with $32,800. But in today's dollars, what it's really worth is $20,367. Now, when we look at net present value, what we're looking for to decide if we should do the investment or not is we're looking to see if net present value exceeds 0. And the reason we're doing that is because when we do this calculation, what we're saying here is we're saying, okay, so when we decided to do this project, we've decided that it has to have a 12% return on investment. So we're going to evaluate the project using a 12% return on investment. So that's why when we go to the table, we use 12%, because we're like, if we use 12%, we're happy if we break even. If we use 12%, we're happy if the net present value is 0. Now, what's missing from this, okay, because all we're doing is looking at future cash flows coming in, what's ironically missing from this is where did we put the cost of the machine? So that's what they haven't finished. Oh, wait, here we go. There we go. So we get in $20,367. Here's the cost of the machine, which means we have $4,367 left over. But what that really means is that we have earned 12% on this investment, plus we have $4,367 left over. Because what we're really looking for, the magic number, is this 0. Okay, questions on this?
No.
No.
Just not comfortable yet. So if the net present value is greater than 0, you should invest. If it's less than 0, you wouldn't want to invest. Now, there's still other things to look at when we're comparing multiple options. All right, so let's say we had uneven cash flows. Now, with uneven cash flows, we can't use an annuity table, because an annuity only works if you're getting the same amount of money every single period. So we can't use an annuity table. So what we're going to do is now we're saying, all right, so let's look at these 3 different projects. In the first project, we get 5,000, 5,000, and 5,000. In the second project, we get 8,000, 5,000, and 2,000. In the third project, we get 1,000, 5,000, and 9,000. Now, if we were using how long it takes to recoup our money, the 2 projects would look identical. So we have to use the present value table. And the reason we have to use the present value table is because each of these is a different amount. So this present value number is going to be like, this is going to, year 1 is going to be N equals 1 and I is 10. And then for this next year, it's N equals 2 and I is 10. And for this next year, it's the number of years equals 3 and interest equals 10. So what we're doing is, when we go to this table, we are looking at the interest rate of 10, and for 1, 2, and 3 periods, 0.090982647513. So when we go back here, turn it down far. Here's our, from our table that we just looked at. So what happens here is we say, okay, well, $5,000, if we discount it back 1 year, is worth $4,500. $8,000 is worth $7,000, and $1,000 is worth $900. But look what happens here. $8,000 discounted back 1 year is worth $7,200. $9,000, because the money's worth more today than later. $9,000 discounted back 3 years is only worth $6,762. Because the farther out we go, the less the money is worth to us. So even though each one of these brings in $15,000, because of the timing of the cash flows, the first two projects would meet the net present value test, but C would not, because all of the cash is coming in toward the end, which makes it where the present value is less. So the timing of the cash flows can make a big difference. All right, are we good here? Maybe. So when we do the present value, what we can do is we can take, because it's like, okay, so $435, $908, what does that mean? I mean, well, what does that mean as far as percentages? It's like I was shooting for 10%, but if I end up with 908 left over, what percentage rate is that? What does this mean? So what we can do is we can say, here's our present value of our net cash flows, and we're going to divide it by our investment. So now when we do that, like here we're investing, the present value is $900,000. We're investing $750,000 up front. So that has a profitability of 1.2. In this project, the present value of all of the future cash flows is 375. We're spending 250 on the project, and it actually nets us 1.5%. So the higher the net present value and the higher the profitability index, the more that project is going to bring in for us. I know you're getting tired of this. We're almost done. Okay, so here's a cool thing. You don't have to be able to do this. Internal rate of return. We're going to take the present value of the cash flows minus the initial investment. But I wanted to show you, this part isn't hard. Okay, so the problem with internal rate of return, which is why you don't have to do it, is because what internal rate of return does is it works backwards. You end up with the information. God, I used to hate doing these. You end up with the interest rate and the number of periods and the dollar amount, and then, or you don't have the interest rate. And then you calculate this number, and then you're looking on this table for this number. And the problem with using the tables for an internal rate of return is that it'll often be like between 6 and 7%. So then you're like plugging different numbers into trying to figure, is it 6.1? Is it 6.2? Oh, that was too high. Is it 6.1.5? And you get the picture. But see, fortunately, we have a solution for that. See, it's like here you take the present value factor. You're looking for the present value factor. The good news is that Excel does it. Where'd it go? Which is why I left this here. You don't have to know how to do it. You don't have to use it on the test. But I thought that it was worthwhile because in finance classes you'll use them just to like introduce you to the fact that under the financial formulas in Excel, you can do like net present value, you can do internal rate of return because nobody does them by hand. You can do it on a financial calculator too, but it's really easy in Excel. So I just kind of thought, because like I have a class that uses a lot of it for finance. So it's just kind of like it's there, so you kind of know when you can start thinking about it and looking at it. Okay, thoughts or questions? Let's look at, let me go into our class. I thought I'd have more time. Oopsie, that's not our class. The homework's a lot easier this week. Okay, so looking at whether we should sell, I guess I should share it. That'd probably be beneficial, huh? Okay, we only have a few minutes, so let's just look at one of these. So looking at whether we should sell or process further, right? So Cobb Company has already manufactured 28,000 units of product A at a cost of $20 per unit. The 28,000 units can be sold at this stage for $700,000. Or we could process them further, which is going to cost us $420,000, and convert 5,600 units of product B and 11,200 units of product C. We can sell product B for 105, and we can sell product C for 70. So we want to figure out, should we process product A further? And the only thing that we want to look at is the incremental revenue or expense. So what is my sales amount if I sell it as is?
700,000.
700,000. I make 700,000 for selling it as is. Did I put the 7 in there? And how much can I sell it for if I process it further?
Total of 1,370,000.
Wait a minute, what is it? 1,000,000.
372.
And you got that by?
The 5,600 times 105 and the 11,200 times 70.
Times 70, because we're going to do it into 2 different products. Does that make sense for everyone, how we got the sales dollars? All right, so now we want to look at the relevant costs. So if I sell it as is, I've already spent all of the money that I'm going to spend on it. It costs us $28 per unit. So to date, we've incurred
Zero.
No, the costs incurred to date.
You don't have to put that.
Yeah, I was thinking, why would you have to put that? They give you 2 lines. So if I was going to process this further,
420.
420. They give it to us point blank. 420,000. So yeah, I do have to put the cost here though.
Zero. Above.
And then I got to fill in. So my income is 700. And if I processed it further, what's
952.
952? So my incremental net income or loss, if it's processed further, you know, wait, I'm still, I think we do have to subtract the $28 per unit.
No.
Okay. Incremental net income or loss if processed further. What's the difference between processed further or selling as is? Oh wait, did they want to? Oh, increment. Okay, so you put the number here. No. 789 252.
252.
I can do that in my head. And is that going to be an incremental loss or an incremental income?
Income.
Yeah, I actually make something. So what should the company do? Should we process further?
Process further.
Because we're going to make more money. God dang it.
I think it's going to mark it wrong.
I think it is too.
Oh, no.
And it didn't. Okay.
I put the 0 up top where it says cost process further. I put it up top, and I mean, I guess it makes some difference.
I guess not. It could though. You're right. This is one of the things they've gotten better. I mean, it could make a difference. That's not outside of the thing that I would say would make a difference. So let's see. Departments, oh, so this is fun. So Surge Company expects its 5 departments to yield the following net income for the year. So it looks like we're losing money in Department N, Department P, Department T, and overall. Maybe we should just close the whole company. Or just keep Department O because they seem to be doing well. I wonder what Department O does. So the sales for Department M,
63,000.
here we go. M, 63,000, thank you. And Department N, 35,000. And Department O, oh, is this the one where you didn't subtract 56,000? And Department P, 42,000. I wonder if I'm supposed to be putting this in as negative because we're losing it. And Department T, 28,000.
I think it is.
Department N.
Yeah, I think I think I'm supposed to be putting it in as 0 because as negative.
No, N, P, and T, because they yield negative income.
No, but we're doing sales. But I think because if I give up the department,
then you don't.
Oh, these are the ones I'm
count
keeping.
sales for
I
the
see.
departments that are-
MNOPT.
Take out N.
So
Okay,
you're
yeah.
not gonna add sales for the departments that
Right.
are being eliminated.
Right. That's what I was thinking, that there's a problem with the sales being there for all of them. Okay, so in Department N, it has a loss, so I'm not going to have any revenue. I'm going to get rid of Department P, and I'm going to get rid of Department T. I like this exercise when they do one at a time, and you start realizing that you're going to eliminate all of them. Okay, so for Department M, we're going to keep all of our avoidable costs because we're still keeping the department.
E8.
And 51.8 unavoidable, we're keeping those two because we're keeping the department. Do I have to put these in as negative or does it know?
No.
Okay,
Unavoidable is 9,800.
thank you.
Avoidable.
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 Is that right? No.
Unavoidable.
1,000.
1,000.
Good God, what is wrong with me? 51,800. Oh, yay. Okay, Department N, we're getting rid of. So we are going to keep
The unavoidable.
the unavoidable. So avoidable is going to be 0, but the unavoidable is going to be 12,600. Okay. For Department O, we're going to keep them. So my avoidable, I'm going to keep. And my unavoidable, I'm going to keep. 4200.
Yes.
For Department P, I'm going to get rid of them. So my avoidable is going to go away, but my unavoidable I still have. So 29400. And for Department T, I'm going to get rid of them. So I'm going to keep my unavoidable of 9,800. And I'm not going to have any avoidable costs. Oh, okay, so before I had a total net loss of 4,200. If I eliminated all of my unprofitable segments, I now have a total loss of 21,000. Probably not a good idea. And the exercise that I like we used to do is we would go through and we would do like each one where you eliminate the first one and then you're like, oh wait, this other segment's now negative. Well, let's eliminate them too. Oh wait, now my other segment's negative. Well, then it's got to go. Oh wait, now my company's losing money. I guess we should close. All right, so this makes sense, right? These are much easier, aren't they? How's the homework? The homework's not as bad either, is it? Okay, so I looked at all of these, and they for both practice sets, and this is the same. Here, departments with sales less than avoidable expenses will be eliminated. And then, so let's see what the homework looks like. Because we can work, if there's issues with the homework problems, we can work some of them on Thursday while we're reviewing.
Are you allowed to put the hints on the homework?
The option isn't available.
Oh.
And I found that out because I went in and I have the hints selected, but apparently it's like for practice problems, it'll do it, but it won't do it for homework. So this one is incremental cost of making or buying. So you're going to put down the cost that would, the revenue and the cost that would be different if we made or bought it. So for making the units, we have our cost. For buying the units, we just have what we're paying for. Now we have, do we want to make the part or buy the part? Oh no, where do we want to sell? Do we want to sell to a secondhand shop? Do we want to disassemble and just redo it? Or do we want to just rework it? So you're going to put down the revenue and the expenses for each one of those. For this one, there's a departmental income statement. So we're looking at if we close Department 200. So what you have to do is with a sheet of paper, go through here and figure out, okay, what affects Department 200? So like the full salaries of 2 sales clerks are charged to Department 100. The full salary of 1 sales clerk is charged to Department 200. Okay, so I can eliminate that. The salary of the 4th clerk works half-time in both departments. Okay, I can eliminate half of that. So it's not harder, it's just more detailed because you have to go back and look at this and say, okay, like sales clerks, you know, how much do they make and how do I divide them up? So you just have to, which it says right here, sales clerks who each earn $500 per week. So you just have to, I would take a sheet of paper and put down, you know, my avoidable and my unavoidable costs for 200. And then you just go and fill in my total expenses. Here's what would be eliminated if I got rid of that department. Here's the expenses that would remain if I got rid of that department to get down to your total expenses is all you're doing. So it's detailed, but it's not harder. Department. And now you're doing the same thing as before. It's the same information. We're just adding on to it. Now we're looking at the revenue minus operating expenses. So now we're saying, because on the one before, all we were looking at were expenses. Now we're looking at revenue minus expenses. Same one. And now we're looking at the difference between our combined net income and what it would be if we made these changes. Okay, this uses, now we're doing expected cash flows, and you have to use your present value tables, and these are links to the present value tables. Payback period, all you're doing is putting down the amount of the project divided by the amount of money we're getting back in from it over the years, and it'll tell you the payback period. And your accounting rate of return. And this is present value using 9% as the discount rate. And it looks like an annuity. Assume the cash flows occur at the end of each year. 9% is the discount rate. So where's the cash flows? Where's the cash flow? Oh, it's up here. Requires a $310,000 investment, 5-year life, no salvage. And Project Z requires a $310,000 investment, 4-year life, no salvage. And these are the predicted annual results. So this is the sales that they're going to generate. So the sales that they're going to generate, the net income, is how much money is coming in every year. Okay, so if you have questions about them, we can look at them on Thursday, and we'll review for the quiz. We'll review for the final. So we'll go back through everything. Okay. It's almost over. I know, right? I'm so sad. Everybody wants accounting to be over. No, I totally understand it.
Spring break.
I remember, yeah, spring break, I know, right? I remember when I finished my last intermediate accounting class thinking, oh, thank God, I'll have some free time. I'm not sure where that went. But yeah, spring break. Actually, and it's really cool because the spring break this year at several schools that I'm with coincides with my kids' spring break and my husband's spring break.
Nice.
I know, so I actually think, so I guess it's better that I'm sick now. I actually think we might be able to go do some stuff. Okay, so I will see you on Thursday. Call me if you have questions. If there are questions about this, flag it. Shoot me a text or an email or something if there's something you're struggling with that you want to talk about during the class. Because I'll put together the quiz review and then I'll think about time-wise the whole class, okay?
Oh, quick question.
Yeah.
For the final project, it can be in bullet form, right? Just answer the question.
Yep.
Okay.
Actually, the questions are numbered, right?
Yeah.
So it'd be nice if you numbered them.
Okay.
Yeah, it doesn't have to be a narrative format. And I won't count off for font, although I'd rather you use 12-point font because that's what APA is. But he says 11, and where he gets that, I don't know. But, I mean, I'm not going to count off for that. I'm basically, if you turn something in that looks like you did the work, I'm happy because it's not a paper.
Do CMAs or CPAs generally make more money?
CPAs, because they can do things that CPAs, because a CPA can do what a CMA can do, but a CMA cannot do what a CPA can do. Now, that being said, if let's say I was in managerial and that's where I was going to stay. I worked for large, you know, a large manufacturing company. I might choose to go back and get my CMA. It's nothing compared to the CPA exam. I mean, it's nothing compared to it. But there are things that a CPA can do that a CMA can't do, and that's what makes it worth more money. Even teaching. I mean, it's like I could teach managerial accounting with the CMA, but I couldn't teach any other accounting class. And it's not on the CPA exam. I had somebody tell me it was, but it's not. It's not GAAP. Okay.
It's the hardest out of all.
I think it's the hardest because it's different and there's only one class in it. You know, and the other thing is, in the real world, there's a lot more latitude because what you're really doing is looking at how to build reports that are useful for management. So there aren't like steadfast rules about how to put something together. And yeah, the beginning of the class was intense, but so was financial accounting. Because remember, in the first 2 weeks, we did all of the financial statements, and we did all the account names, the accounting equation, debits, credits, journal entries, and closing entries, and adjusting entries, all in the first 2 weeks. Remember? So they're both intense. Whether you take them over 4 weeks or 8 weeks, it doesn't matter. It's just intense for a longer period of time. So, yeah. All right. You're welcome to call me if you have questions. I'm going to bed. I'll see you Thursday. Or hopefully
Thank you.
All right. Good night, you guys. Thank you for coming. I'll post the video in the morning.
Okay.